okay, expect rate cuts later. Obviously, growth will be decimated, so rate cuts are expected. But when you look at the CPI rates at 9.87, you don't get the feeling that inflation is going to give you that space. And this is the government getting into election mode, and there is a food security bill next year. It doesn't look like inflation is going to go away in a hurry. So I don't know how much space they will have. Even if growth simply cries out for a rate action, is inflation going to give you the space after the rupee? That might be the problem, a few months down the line. Okay, Hemant Rustagi of Wiseinvest Advisors is with us. Hemant, what would you advise a retail investor? We are all going to see an impact on our debt fund investments, our fixed income fund investments. How should we react? Should additional money not be put into these two funds, and should we perhaps stick with the stupid old FD?
Well, I think we've already seen that the steps taken by RBI have had a negative impact on the debt market. We've seen the 10-year government bond yield moving up from 760 to 8.05. So clearly, considering the fact that the bond prices are inversely related to the bond yield, we are going to see a negative impact immediately. I think the most impacted will be the medium and long-term debt fund, which are called basically the funds that follow duration strategy. I think they are going to be the most impacted. But another category of fund which has been very popular among the retail investors has been dynamic bond fund. But fortunately, there, as the bond yield were move up from 710 to 760, most of the fund managers in this category have been actively managing their duration and also prune their GSEC exposure. So I think even though these funds are going to be impacted, the impact may not be as much as you will see in the duration funds. And also considering the fact that any security which has a maturity of 60 days or the residual maturity of 60 days has to be marked to market, I think the impact will be there on short term as well as even ultra short term. But of course, the impact is going to be much more severe. So my advice would be that all those investors who have invested, especially in the last few months, are the ones who are going to be impacted the most, because they've already been seeing negative return, and now they'll see a steep cut in terms of as far as the returns are concerned.
As Navneet was saying, Hemant, Navneet was saying that probably rate cuts will start next year. So investors into these dynamic bond funds should stay put, you're saying, and not book losses, maybe over a 12-month period or a 18-month period, they will recover?
Yes, absolutely. I feel, especially like I was mentioning, investors who have come in the last few months, looking at the last 1 year performance and also, hoping that there will be rate cuts. I think if they stay put for another 15 to 18 months, and if they are, willing to face or be ready to face the volatility that will come from time to time, I think they need to stay put. I don't think it's a time for them to really exit. But for those investors who want to put fresh money, can definitely look at maybe short-term debt funds, and also to some extent maybe consider funds that follow accrual strategy. I think this is the time to have a mix of different funds rather than going whole hog into duration funds or dynamic bond funds.
Okay, we have a caller who joins in, and an investor, Amol Namdev, calls in from Chandrapur with his query. Hi Amol, good afternoon.
Good afternoon, madam.
Hi, tell me, what's your question?
I want to ask one question about health insurance plan.
Sure.
I want to buy a policy which will cover my family. I have one daughter only.
Okay.
And what care should I take before purchasing that health insurance plan?
Okay, so he wants to know which is the best health insurance policy, if I'm not wrong, for himself as well as for his child. What would you recommend, Hemant?
Well, I think considering the fact that his is a small family, a young family, I think a family floater health plan would be apt for him, because he has a small daughter, and like I said, it's a small family, so he should go for a family floater health plan. A couple of plans that he can consider is Optima Restore of Apollo Munich Health, and also MediPrime of Tata AIG. I think these are the plans that he can consider for health insurance for his family.
Okay, Hemant, thanks for joining us and giving us your opinion on the personal finance segment and how to approach, more importantly, your fixed income funds, if you have any at a time like this. But do remember, if you have any personal finance queries, you can always send us an SMS, type YM, follow that by a space, and send your questions to 51818, and we'll make sure to answer them on our show.